Hey there, it's Tony from Wealthfront again. As you know, I work here and I love talking everything money. I talk to clients every single day about topics I'd love to share with more people. So, going forward, we're going to be here giving you the content we think everyone should and deserves to know. So make sure you hit subscribe to follow along. All right, so most of you have likely heard the word passive when it comes to investing. But have you ever thought, what does that actually mean? Like, at its core, passive investing is an investing strategy meant to maximize returns by minimizing the buying and selling activity. So essentially, you're just holding on to investments at its core. All right? Now, this is in stark contrast to what is referred to as active investing, where the goal is to outperform a passive strategy by actively trading investments. If you want to learn more about this, about active strategy, we're going to be posting content going forward on this as well. But let's talk about passive investing on this one. So the most common form of passive investing is what's referred to as indexing. And that's just a strategy to purchase a broad index. The most common typically is S&P 500. We've all heard that. And so what you're doing is you're purchasing this broad index through a low-cost exchange-traded fund, usually referred to as an ETF. At its core, passive investing just builds on this assumption that the market goes up over the long term. So you have to take more of a bird's eye view of the market and avoid paying attention to temporary market fluctuations. This truly is the only way that passive investing works, with this bird's eye view. So with that said, let's talk about the pros and cons of passive investing, starting with the pros, of course, right? First off, fees. Most ETFs, or passive investments in general, are managed by software, and therefore the cost to own these is so much lower than mutual funds or any other actively managed investments out there. There are no overhead costs to pay the expensive fund managers overlooking their corner office in Manhattan, or to implement complex strategies. These fees that you pay in passive investing are referred to as the expense ratio, and you can find ETFs that cost as low as next to nothing. Second, tax efficiency. Passive investing also creates more opportunities for tax loss harvesting, which is a strategy that can be used to offset taxes you owe on investment gains, or even better, ordinary income. Optimizing for taxes can save you a ton of money long term, and that's why here at Wealthfront, over 96% of our clients with taxable investment accounts have had their advisory fees fully covered by tax loss harvesting. All right, lastly, simplicity. There's just no extensive research needed. Owning an index or a group of indices is far easier to implement and comprehend than a complex strategy that requires constant research and adjustment to buy individual stocks. Yeah, it's truly that simple as it sounds. Okay, so now let's talk about the potential downsides to passive investing, because you gotta be aware of these. Number one, in passive investing, you don't adjust your strategy during the highs or the lows, which does mean you have to be willing to hang on to your investments during market downturns. That's because, again, passive investing does rely on that assumption that the market overall goes up. But we've clearly seen some recent times where that just doesn't hold true in the short term. Just take a look back at 2020, and you will see why holding on, especially during those market downturns, can really pay off long term, considering what happened after it hit its rock bottom during 2020. Now, we don't know what the market will do in the future, and in fact, no one does. All right, but it can be helpful to look back at these past market downturns to understand what type of role passive investing can play. And number two, it can be boring. Passive investing might not be nearly as fun as day trading, but no one ever said the best strategies to build wealth were also the most fun. It's so simple that you may find yourself bored, but like we always say, slow and steady wins the race. So in summary, at Wealthfront, we use passive investing by buying a handful of ETFs, each targeted to track a specific asset class like US stocks, foreign markets, emerging markets, things like that. It allows us to save our clients money on investment costs while also tracking the overall global market through proper diversification. And look, there's an overwhelming amount of data out there that proves this strategy, along with tax loss harvesting, to be superior long term. So we encourage you to consider it. And again, if you want to dig into this more, we'll link some additional resources for you below. As always, like, subscribe, comment. We'd love to hear from you. This is Tony from Wealthfront. Thanks so much for listening again, and we'll see you next time.